good morning. Please come to the next chapter, NBFC, which is called Non-Banking Finance Companies. First paragraph 1, meaning of NBFC. What is NBFC? So these are finance companies, but not a banking company. These are finance company, but not a banking company, because their main business is receiving deposit. Main business is receiving deposit from the public. They receive deposit, give it as a loan to those who require it, but they do not give checkbook to the customer. They do not open ATM for the customer. They do not open saving account and current account for the customer, but they take the deposits only. And generally they give high rate of interest. Why they give high rate of interest? Because there is more risk in the deposits made with NBFC as compared to a bank. Banks are subject to strict supervision of RBI. NBFCs are also subject to supervision, but the supervision is relatively less in case of NBFC as compared to banks. And that is why, in order to attract the depositors, they offer a high rate of interest compared to a bank deposit. So first point, what is NBFC? It is a financial institution which is a company or a non-banking institution which is a company with principal business of receiving of deposit under any scheme, arrangement or in any other manner, or lending in any manner. So what they do, they try to bring two parties. One who has surplus money, they take deposit from him, and the one who needs money, they give loan to such people. So that is the function of NBFC. Any NBFC name that you know of, name any NBFC. Muthoot Finance, Mannapuram Gold Finance, Reliance Capital, Tata Capital, Bajaj Finance, Birla Finance. So almost every big business houses have got one NBFC also, because they raise funds, give loan, and this is a good source of income. So NBFCs are supposed to follow certain guidelines issued by RBI and other regulating agencies, so that the interest of the depositors are protected. Because you will deposit money, and then they may not refund you. Your money is lost. You are a general public, so therefore there will be a loss to the public. To ensure that public money is protected, public interest is protected, there are certain regulations imposed upon NBFCs. First is, this NBFC should have a minimum net owned fund to be rupees 200 lakh. What is 200 lakh? 2 crore rupees. So minimum net owned fund should be how much? 2 crore. So any chotu motu company cannot start NBFC. You have to put your own money. How much own money you have to put? 200 lakh. Why you should put lakh? Means 2 crore. Why you should put your own money in your business? So that you will be careful while taking the risk. When your own money is invested in business, you are more careful. When your own stake is not involved, you are careless. Yes? Yes? Yes or no? Yes. Now your question will be, how to compute NOF? NOF? Net owned fund. Section 45 IA of RBI Act 1934 is defined as follows. So one formula for you today. First we will calculate owned fund, and from owned fund we will compute net owned fund. So you have to somehow, anyhow know this formula. So first you will take aggregate of paid up capital, add share capital. add free reserve appearing in the latest balance sheet of the company. So share capital and reserve minus accumulated balance of losses. So if you have a debit balance in P&L account, less. If you have any deferred revenue expenditure, less. If you have any other intangible asset, less, because you can't rely upon them. So that is my owned fund. Formula for owned fund. Yes, you. Formula for owned fund. Paid up capital plus free reserve minus losses, deferred revenue expenditure and other intangible assets. Now net owned fund. First you will compute owned fund minus investment in shares of subsidiaries or companies in the same group or other NBFC minus book value of debenture, bond, outstanding loan and advance made to and deposit with subsidiaries and companies in the same group. Underline, to the extent such sum exceeds 10% of the owned fund. To the extent such sum exceed 10% of the owned fund. So if you are not able to remember so much, this is called investment in group companies. Investment in group companies and other NBFCs. Investment in group company and other NBFCs. Okay. If it exceeds 10% of the owned fund. If it exceeds 10% of the owned fund, then that amount you will deduct it. Is it right? For example, aggregate fund is 400 rupees here. This figure. This is 400. Okay. And suppose these two items total is 200. How much is that? 200. So how much will be my net owned fund? No, 200 is wrong. To the extent such sum exceed 10% of owned fund. What is owned fund? 400. What is 10% of owned fund? What is in excess of owned fund? So I am going to deduct 160 here. How did you reach this magic number 160? 200 minus 10% of owned fund 400. 200 minus 10% of owned fund 160. So what is my net owned fund? 240. Net owned fund will be 240. 400 is owned fund minus investment in subsidiaries and other group companies in excess of 10% of own fund. So up to 10% of own fund you don't need to deduct. But more than 10% of own fund you'll have to deduct because these are all group companies. Is it right? So 200 rupee is my investment in subsidiary group companies. Up to 10% means 40 I don't need to deduct. But more than 40 I need to deduct. So what is my net owned fund in our example? 240. And what should be the minimum net owned fund of a registered NBFC? 200 lakh. Otherwise RBI will cancel their license. Many licenses have been cancelled by RBI in the past for not maintaining the net owned fund. Now question for you. Income recognition principle. Income recognition principle is similar to bank. Similar to bank. So I hope you have studied banking company final account or you were absent during those days. Present, that's good. Income on non-performing asset should be realized, recognized only on receipt basis. So the moment you find an advance has become NPA, follow cash basis of income recognition, not accrual basis. What about income relating to hire purchase asset where installments are overdue for more than 12 months? Oh, Nalayak is not paying. It is more than 12 months. So if it is more than 12 months, then it must be recognized when the higher charges is actually received. Up to 12 months accrual basis. But the moment the installments are overdue, For more than 12 months, you will follow receipt basis for recognition of income for higher charges. Next, installment relating to leased asset, where lease rentals are overdue for more than 12 months. Again, more than 12 months underline. The moment the lease rentals are overdue for more than 12 months, you will shift your method of accounting from accrual to cash, and you will recognize the lease rental only on actual receipt basis. Income from dividend on units of mutual fund must be recognized on cash basis. Whenever you receive the dividend, that day you recognize. Income from dividend on shares of corporate bodies, dividend on shares of corporate bodies, it must be recognized on accrual basis when such dividend have been declared by the corporate body in the annual general meeting. As usual, once your right to receive the dividend is established, AS9, have you studied AS9? Once the dividend is approved by AGM, then we can recognize the dividend income, and the NBFC's right to receive the payment is established. Accounting for investment. These NBFCs invest their money in another investment, okay? You are the investor, see, he is the investor. Can you see them? One more. He will invest in NBFC. Then NBFC will invest in securities. NBFC will invest in securities. Now the question is, how will NBFC do the accounting of this investment? So first of all, investment will be divided into two types: current and long-term investment. Does it remind you of AS13? In AS13, you have studied what? Investments are of how many types? Current and what is a current investment? Yes, what is a current investment? Which are intended to be held for not more than, and which are readily realizable. Two conditions must be fulfilled. They can be easily converted into cash, and the intention is to hold for not more than 1 year from the date on which the investment is made. Golden rule number 1 today: current investment will be valued at cost or market value, whichever is right. Each category of such investment must be valued scrip wise, and depreciation or appreciation be aggregated under each category. Net depreciation, if any, for each category of investment shall be provided for or charged to P&L account. Net appreciation, if any, shall be ignored. The depreciation in one category of investment shall not be set off against appreciation in another category. Now understand one by one what they have done. Suppose we have two category: equity share, preference share. Investment in equity share, investment in, and in equity share we have two, A, B. In preference share we have two stock, C, D. Is it right? Cost, market value, 100, 120, 90, 130, 80, 90, 70, 60. Where is 80? Here is 80. Where is C? Here is C. There are a lot of C's around you also. Okay. So, Rahul Baba, one is enough. No, one is in jail, so one more we require now. Okay, come to the topic. Come to the topic. What you will do, take total of this 220, take total of this, let us make it 140. So this will become 230. Is it right? Here, is it 150? This is also 150. I'll make it 30. So this is, say, 120. How will you value equity share? 220 or 230? 220. Loss within a category can be set off against gain in another category. Loss in one stock can be set off. You see, there is a loss here, but there is a gain here. So loss in one stock, in one category, can be set off against gain in another share in the same category. But the loss in one category, means preference share is a category. Here we are having a loss, cannot be set off against other category of investment. Okay, the meaning of this line, the depreciation in one category, preference share, will not be set off against appreciation in another category. Second, if there is a net depreciation, in preference share there is a net depreciation. Can you see? Cost was 150 and the market value is 120. There is a net depreciation. Net depreciation will be provided for. Net depreciation will be provided for. But net appreciation, you see in equity share there is a net appreciation. There is a net? There is a net? Will be ignored. Net appreciation will be, why? Concept of anticipated loss. Recognize. Anticipated gain should not be recognized. So that is the rule for investment valuation. This is a favorite question of your favorite institute. Is it right? Now how will you value long-term investment? Long-term investment means investment other than current investment. For long-term investment, the golden rule is cost. Unless there is a decline in the value of investment other than temporary, not permanent, other than temporary, then we'll make a provision for decline. What about unquoted equity share? What about? Now first you tell me what is unquoted equity share. How will you value unquoted? Unquoted means which is not quoted. What is quoted? Which is listed on the stock exchange. Is quoted. Where the price is available from the market is quoted. Reliance share price is quoted. Is it right? AS Foundation share price unquoted. There is no market where our shares are traded. Is it right? Then you have to value it. You have to value it. How will you value? See the rule of valuation for unquoted equity instrument. Unquoted equity share shall be valued at cost or breakup value, whichever is lower. Then you are very interested in knowing what is breakup value in the next slide. However, NBFC can substitute fair value for the breakup value of the shares if considered necessary. So cost or breakup value, whichever is lower. In place of breakup value, we can take the fair value if necessary. In case of non-availability of balance sheet for 2 years, suppose this unlisted company has not prepared balance sheet for 2 years, then such shares shall be valued at ₹1 only. 1 rupee value, just to show the asset in the balance sheet. Is it right? Unquoted instrument, if they have not prepared balance sheet for 2 consecutive years, they will be valued at 1 rupee. But if suppose they have prepared balance sheet, then cost or breakup value, whichever is lower. And if you want, you can take fair value in place of breakup value. Sir, what is breakup value? Next paragraph. Breakup value means the equity capital and reserve as reduced by intangible asset and revaluation reserve and divided by number of equity share of the investee company. So I have given some space for writing the formula somewhere below. Can you see that? Say yeah. Okay. Write one formula. In that space provided to you, formula write down. Breakup value is equal to this page only, page 2 of this chapter only. In paragraph 5 below, you have some space. Say yes. Use small font. Otherwise, use small font. Okay, otherwise you will not be able to finish. I have to write some more formula there. So breakup value is equal to, write down, ESC, equity share capital, plus reserve minus IA, intangible asset, minus RR, revaluation reserve, write fully, minus revaluation reserve, divided by NOES, NOES, number of equity share, NOES, but the spelling is NOES. So you will be able to calculate the breakup value yourself if given in the problem. Yes, sir. Equity share capital plus reserve minus intangible asset minus revaluation reserve divided by number of equity share of the investee company. Fair value, one more formula. Fair value is equal to earning value plus breakup value upon 2, earning value plus breakup value upon 2. Now you are so keen on knowing what is earning value, breakup value, you understood. So now we'll come to earning value. Below it is written, earning value means value of an equity share computed by taking the average of profit after tax as reduced by preference dividend and adjusted for extraordinary and non-recurring item for the immediately preceding 3 years and further divided by the number of equity share of the investee company and capitalized at the following rate. By the time you finish reading the sentence, you forget what was written in the first part. Is it right? So we'll divide into 3 parts. First part, to calculate average profit. How will you calculate average profit? Of last 3 years, you will take profit after tax of last 3 years, subject to some adjustment like deduct preference dividend. In that formula, please write down. Average profit is equal to PAT. What is PAT? Minus preference dividend plus minus extraordinary and non-recurring item. Extraordinary means loss due to fire, loss due to earthquake. That is called extraordinary item. Plus minus extraordinary item and non-recurring item. And what is non-recurring item? Which is not occurring again and again. Example, sale of fixed asset. Okay. And this calculation you do for last 3 years and divide by 3. Divide by 3. Why divide by 3? Average. average, first to calculate this figure for last 3 years, each year, take total, divide by 3. That is going to give you average profit. Then this formula, earning per share is equal to average PAT divided by number of equity share. Average PAT divided by number of equity share. Are you writing? Average PAT divided by number of equity share. So I got the earning per share. And one last formula I will write here in this area. Last formula, value per share is equal to EPS upon capitalization rate. EPS upon capitalization rate. Capitalization rate means required rate of return. Is it right? Capitalization rate means required rate of return. Now here also there are 3 types of companies. If it is a predominantly manufacturing company, then capitalization rate will be 8%. So then EPS divided by 8%. That will be the value of the share. Okay, earning value of the share. If it is a predominantly trading company, then capitalization rate is 10%. And if it is any other company including an NBFC, then 12%. If the investee company is a loss-making company, if the investee company is a loss-making, so PAT will become negative, then the answer will be earning value is 0. Earning value is 0. Now see the sequence. Unquoted equity instrument at cost or breakup value. In place of breakup value, we can take the fair value. Breakup value is equal to share capital plus reserve minus intangible asset minus revaluation reserve divided by number of equity share. Fair value is the average of earning value and breakup value. To calculate earning value, first I have to compute the average profit after tax of last 3 years. Average profit after tax will be calculated by taking profit after tax minus preference dividend plus minus extraordinary item and non-recurring item and divide by 3. Then I will compute EPS, average PAT divided by number of equity share, and EPS divided by capitalization rate will give me earning value per share. Earning value per share plus breakup value per share is the fair value. Yes, you are right, average. Now we are going to solve one question which is printed somewhere in the later part of this chapter. Kindly come to there is one question number 4 on page 9 of this chapter. Mark important. Question number 4. XYZ is a non-finance company, NBFC. Can you see that question? XYZ is an NBFC. Page 9. It makes available to you the cost and market price of the various investment held by it. There are scrip. Scrip means right equity share. A, B, C, D, E, F, G. Cost, market price, good news. Total is also given 271, 294.80. So which one you will take? Lower of the two. 271. Mutual fund M12, MF1, MF2, MF3. Which one you will take? 36. Then on the next page there is a GS also, government securities. GV1, GV2. Total 90, 92. Which one you will take? 90. Question number 1. You are required to answer the following question. Can the company adjust the depreciation of a particular item of investment within a category? Within a category. For example, in case of equity share, you can see there is some loss in one category and there is gain in some other category. Within a category, the loss can be set off against the gain. Answer on the screen. Write down in the notebook. Got one notebook? Write chapter name, chapter number and answer. Dear student, write down one line answer for this first part. Write answer for A. Be active. The answer is yes. Yes. The cost and market price. The cost and market price of current investment should be aggregated under each group. Should be aggregated under each group. So it is allowed. Within a category, the loss can be set off against the gain. Within a category, the loss can be set off against gain. Second question in your book. What should be the value of the investment? Anybody? What should be the value of the entire investment? Equity share you will value at 271. Mutual fund you will value at 36. Government security will value at 90. So write here answer 2. Value of investment. Value of investment. Write down little fast. Value of investment, lower of the cost and market price. Are you writing? Lower of cost and market price. Work hard. This is CA exam, okay? You are not yet understanding where you have landed. You will understand what is CA exam only after appearing it once. Okay? Before that, any amount of motivation will not help you. Only after appearing for the intermediate exam, you will realize its importance. Haji, you have some query? Are you writing equity share? How much you said? Mutual fund? Government? Total? Okay. Question number C. Is it possible to offset depreciation investment in mutual fund? You see, in mutual fund there is a loss, heavy loss, and appreciation in the value of investment in equity share and government security. You will say no. Answer 3 write down. No. No. The depreciation in one category of investment, the depreciation in one category of investment shall not be set off against appreciation in another category. Shall not be set off against appreciation in another category. The depreciation in one category shall not be set off against appreciation in another category. Okay. Now write one homework question number 6. Answer is also there. Only your duty is, what is your duty? Read, solve in notebook and check the answer. If you have a difference of opinion, then we will discuss tomorrow. Come to back to paragraph number 6. Back to para 6. Okay. Paragraph 6. NPA. What is full form of NPA? So in case of NBFC also, the problem of NPA is very severe. Like banking company, they also give loan advances and it is too difficult to recover those loans and advances. So how do we identify whether a loan, advance or an asset has become an NPA? So similar rules were there for banking company also, but this is slightly different. This is concept is same, logic is same, but the benchmarks are different. Benchmarks are different means the time period given here is different from banking company. Is it right? Accordingly, you will solve the problem in the exam. NPA means an asset in respect of which interest has remained past due for 6 months. So for 6 months that fellow is not paying the interest only. From the due date 6 months have passed. So then that asset will become NPA. If it is a term loan, inclusive of unpaid interest, when the installment is overdue for more than 6 months or on which interest amount remained past due for 6 months. So if it is term loan, either the interest or the installment has become overdue for more than 6 months. Overdue means from the date they became due. 6 months have expired and this gentleman has not paid the amount, NPA. If it is a bill, it remains overdue for 6 months. So 6. However, in some other category it will be 12. Be careful. The nature of interest of debt or the income of a receivable under the head other current asset. Suppose any other current asset item is there in the nature of short-term loans and advances, which facility remained overdue for a period of 6 months. So interest, term loan, bill, any other current asset on which interest or installment is overdue for 6 months, then they will become NPA. Next paragraph. Any due on account of sale of asset, means your customer basically, or services rendered, or reimbursement of expenses incurred. So any amount receivable for sale of asset, services, reimbursement of expenses, which remained overdue for a period of 6 months, NPA. So they should have written one line only. You go and sit in the RBI, na? Why you are sitting here? You should say, we will try after becoming CA, right? Then the lease rental and hire purchase installment. In case of lease rental, now there is an exception. Lease rental and hire purchase installment which has become overdue for a period of more than 12 months. Now here the rule is 12 months. Which two items 12 months? Lease purchase, lease rental, and if it has become overdue for a period of more than 12 months. So you have learned so much. You are happy. All of a sudden there is a amendment. So that has become outdated. This you have to learn now. Recent amendment. So you should have started here only. Yes or no? After learning so much, you found it has become amended. Lease rental and hire purchase assets shall become NPA. Wait. If they become overdue for 9 months, earlier 12 months, for the financial year ending 31st March 2016. That means for the year ended 31st March 16, now the rule will be 9 months. That means for the previous year 31st March 15, the rule was 12 months. And now if it has become overdue for 6 months for financial year ending 31st March 17. So what the government is doing, it is tightening the screw on these NBFCs. From 12 months, they moved it to 9 months. And from 9 months, they moved it to 6 months. And from 6 months, they moved it to 3 months for the year 31st March 2018 and thereafter. Now the student will ask, what will I do in the exam? Simple. Check the year ending date. If it is 31st March 15, 12 months, 16, 9 months, 17, 6 months, 18, 19, 20, 3. So 18 and thereafter will take 3 months. So that is why I had to take the old syllabus also, because if the year ending date is before 31st March 16, then 12 months is the rule of the game. Assets other than lease rental and hire purchase shall become NPA. Original rule is 6 months, but then there was an amendment. If they become overdue for 5 months for the year ended 31st March 16, for 4 months for year ended 31st March 17 and for 3 months for 31st March 18 and thereafter. So you have to remember, this is not applicable for banking company finance, banking companies. There it is 90 days for everything. Okay, but for NBFC, because this business model is growing, the rules are also changed more frequently, and that is why government, after many years of deliberation, debate, they finally have come to this discussion now that slowly and slowly NBFC will also move towards 90 days NPA norms. So from 2018 now it is 3 months, means 90 days, at par with the banking companies. Are you understanding? Yes or no? Do you understand English or not? Yes, that's good. Every NBFC, because you are used to Hindi, na? So English. Every NBFC shall classify the assets into 4 classes. Good news, same like banking company and same theory also. Standard, substandard, doubtful, loss asset. Standard. What is standard? Means no risk except normal business risk. Customer is good. He is paying on time. Is it right? No risk of interest and installment. That is standard. No serious risk involved here. But substandard means one, if an asset has been classified as an NPA for a period exceeding 18 months. Not exceeding. Within 8 months. It has become NPA. But within NPA category, it is not more than 18 months. In NPA category, if it remains for not more than 18 months, substandard. NPA, from the day it become NPA till 18 months. It will become NPA after 6 months. From here to here till 18 months expire, it will remain NPA for up to 18 months, substandard. Then if it is more than 18 months, doubtful. Okay. Example of doubtful can be term loan, lease asset, hire purchase asset, any other asset. Loss asset. In case of loss asset, there is no time limit, but which has been identified as loss asset by NBFC or its internal auditor, external auditor, or by an RBI inspection, to the extent it is not written off by the NBFC. So one good thing is that the basic logic of 4 type of asset are same, only here the benchmarks are different. In case of banking company, if the NPA is for 12 months, substandard, here it was 18. Then doubtful was more than 12 months there, here doubtful is for more than 18 months. However, after learning so much, what do you find? So now the rule of the game is changing. Okay, from 18 months, it will be treated as 16 months for year ended 31st March 16, 14 months for year ended 31st March 17, and 12 months for year ended 31st March 18. So you will check in the exam, what is the year ending date given? So most probably you will be given 31st March 18 or 17. Then accordingly you will take the time period for classification of NPA. Okay. Now next is provision. Before provision for all loan asset and hire purchase, doubtful asset, an asset remaining substandard for 16 months up to 31st March 16, 14 months 31st March 17, and 12 months 31st March 18. Means from 31st March 18 now the rule will become 12 months at par with banking companies. Is it right? Then there is a provision requirement. Provision, percentage only. Substandard, 0.25%. Standard. Standard asset 0.25%. Substandard 10. Doubtful asset unsecured portion 100%. And doubtful asset secured portion up to 1 year 20, 1 to 3, 30, more than 3, 50, and loss asset. So there is some similarity and some differences compared to the banking company final account. After you have ratified so much, mugged so much amendment. So what is the new rule of the game now? For standard asset, they have gradually increased the percentage of provision required. If it is year ending 31st March 16, you will take 0.3% in your question. If it is 31st March 17, you will take 0.35% for standard asset. And if it is 31st March 18, you will take 0.40%, which is same like your banking company, where also we take usually 0.40% for standard asset. Any query? Now we'll solve. There is one question one. Solve in the book only. No, solve. It will take half minute only. Acha, note down homework. Solve in the book only. Format is also drawn for you. What more you want in life? Tomorrow we will do. Okay. Now we'll continue tomorrow.